Sustainability though, all right, what does that mean in today's day and age?
But also, when the market is in a bear market, people are still making money.
Hey guys, welcome back to another episode of The Way of Wealth. We are very privileged to have with us today Dr. Tanweer Uddin, who is the CEO and founder of the Wholesome Responsible Fund, domiciled in Australia. Really excited to talk about sustainable investments, wealth inequality, and so much more. Watch this space. Welcome, Dr. Uddin.
Thank you so much, Mohammed. Really great to be here.
Yep. How's the last, 10 days been?
Pretty much on a plane. I was in DC, New York, then Birmingham, now here in London, and tomorrow I'll head back home. So a final hurrah here.
Fantastic. Is this the longest you've been away from your family?
No. My trips are getting shorter and shorter now that I have a little one. Okay. Yeah, I think last year I did like a 2-week stint. Again, bit of a multi-country tour visit. Australia's just so far away. If you're going to get out of the country, you might as well make the most of it.
No, I've heard. I mean, if you get out the country, people end up doing all of Europe and, different parts of North America and so forth.
Yeah, and I mean, for my line of work, we're a global fund, so we have clients, partners globally. So we often try and hit up all our different sort of collaborators in different markets.
Cool. Tell us about your fund, Tanweer. Okay, I'm quite intrigued. So you're in the sustainable investment space. What does sustainability, for the sake of our audience, actually mean? What does it relate to? What you're passionate about when it comes to sustainability? Go for it.
Yeah, absolutely. Look, I mean, it's a bit of a hot topic, and there's been a lot of blowback to sustainable investments, ESG, all those kind of things. Is it greenwashing, which is like just basically a marketing gimmick? For me and for our team in Wholesome, we take it very simply. And that is, if we think about capital, essentially you've got capital, we've got financial intermediaries like ourselves, and you've got people who need capital. Yep. And our definition of sustainability or responsible investing is if we can move capital from those who are seeking a return from that capital to segments of society, to businesses, to initiatives and projects that can have a catalytic or a positive impact in either communities, for the environment, and essentially our focus is underserved segments. So banks don't normally play there, other funds don't play there. We want to go out and make a difference, and that's essentially what we mean by sustainable or responsible investing.
Okay, so what causes are you most passionate about then?
So the primary cause that we are focused on in this fund is empowering small and medium businesses globally. We know small and medium businesses are important and they're critical for any economy. Whether they be in the UK or in Kenya or in Pakistan, small and medium businesses make the bulk of an economy. They create jobs and they reduce poverty. So we're very excited about that theory of change, and hence where we invest in that space. Okay,
cool. So you're not just limited to investing in projects in Australia. You're looking at investing into projects all over the world.
Absolutely. Majority of our portfolio is actually allocated outside Australia. We are doing a lot more Australian deals at the moment, but we have investments in Southeast Asia, Middle East, even in Latin America.
Okay, cool. So that could pose currency risk to clients like us. So
yes.
How do you address that? Or I appreciate there's probably a limited amount that you can actually do, but it probably means that the underlying choice of the company that you ultimately lend to, and we'll come on to this notion about lending audience in a second. So how do you choose to give liquidity to one particular company over another?
Yeah, great. So I think there's a couple of things there in what you've raised. So in terms of currency, there are some hard and fast rules that we do follow. So we don't invest in very volatile, unstable economies where the currency is just yo-yoing around all over the place.
Okay.
So for example, I'm originally from Bangladesh. I've met many platforms and partners and businesses in Bangladesh, but we haven't invested there and we won't in the foreseeable future just because of volatility and the geopolitical risk that presents. So there's some hard rules. Beyond that, the beauty of our fund is that we are an open-ended fund. We are investing on a monthly basis. And what that allows us to do is that we can take advantage of dollar cost averaging, which is essentially a strategy in investing that when I'm dealing with things that are moving, I can ride the wave up and down without allowing that to hit the total value of my fund or to hit a particular investor's allocation in one go. So to give a very simple example, if I invest in January and I'm investing from January all the way through to December and the currency is moving, all the pluses and minuses are evening out. So that's one thing. The second thing is that primarily a lot of our investors and our investment is in Australian dollar denominated. So we try and negotiate as far as possible to denominate our investments in Australian dollar. Now, we've become a global fund. We have investors in other countries. I'm in the UK. I'm speaking to some partners here who are interested in allocating to us. We're also looking at exploring other currency denominations. And we have the ability to open up sub-funds or SPV funds, which will be in other currencies. So that's something we're working on. But primarily, those two hard strategies and the dollar cost averaging is how we're able to manage that risk as much as possible.
Okay, cool. Just for the sake of the audience, I know Tanwir said SPV. All it means is a special investment vehicle that you can put monies into. Then that SPV, that vehicle can go on to invest in whatever. Cool. That sounds very exciting. Sustainability, though, all right. What does that mean in today's day and age, Tanwir?
So there is.
Why is it important?
So, okay, first, why is it important?
Yeah.
It's important because capital is not agnostic to impact positive or negative in the world. From a very simple thing that if I choose to allocate money to A, I'm not allocating it to B. Now, if I allocate it to a project, a business, a founder, whatever it might be, if I'm allocating to A and A's mission and activities, then I'm furthering that activity. And it could be positive or negative. So we know there's about, I think KPMG has estimated, or one of these big four, there's about $145 trillion of funds under management with the big, the BlackRocks of the world and so forth, for the sovereign wealth funds and other places. Only 1% of that has been estimated, actually less than 1%, by the Global Impact Initiative Investment in Network under the UN as going towards impact investing. So very little is actually targeted towards initiating projects that are having a positive change. Now, where the rest of it's going, it's not value neutral. There are companies that are funding genocide. There are companies that are polluting the planet. There are companies involving modern slavery. So as investors, we should care about where our money is going. And we have the choice. The Norwegian Sovereign Wealth Fund is one of the most activist investors. They have very hard policies around investing in fossil fuels, for example. They've avoided defense companies because they don't want to, further wars and criminality through that, perhaps. So players are already moving in that direction. The bulk of capital still hasn't moved, but that momentum is increasing. The other important thing to realize, for particularly people who are advisors or fund managers, is there is a major global wealth transition happening, primarily from the baby boomer generation through to Gen X and onwards, and increasingly from males to females, and then from older generation to younger generation. And those trends, the people who are benefiting from that wealth transition are increasingly very concerned and very vocal about where their money is earned, where it's invested, how it's making a difference. So we need to be aware of these things. Now, in terms of how do we measure it, what is it exactly, there's so many different ways you can skin this cat. And there is a spectrum. You have very strict impact investing sort of strategy, which is that the dollar that's allocated will generate revenue from an activity that has a direct impact. So things like, let's say we're going to build affordable housing, or we're going to build a wind farm. So that activity directly is addressing a core social and environmental issue. Then you have sort of filters like, okay, we're going to avoid harmful industries. We're not necessarily targeting things that are positively generating impact, but we're going to avoid things that are harmful. So for us at Wholesome, at this stage of our journey, what we are really trying to do is direct capital. And taking that lens of what I said, the opportunity cost is we want to direct capital away from all the typical investment strategies like stocks and property and so forth, and direct it to small and medium businesses because they are an underfunded segment. Particularly in the developed world, We have minority founders, minority businesses that lack capital for various reasons. And in emerging markets, the financial markets there aren't as mature. They don't have as many financial instruments like bonds or debt capital market players that can funnel into small, medium businesses. There's not a lot of financial data. The credit risk is high. So we are essentially trying to direct capital into those segments whilst also maintaining a very rigorous risk framework. I mean, the currency is just one thing that we try and control for. We apply various other things like how profitable is the business, what industry is it in, what security we can take. So that's our basic definition and theory of change. Allocated to segments that need the capital, that aren't well funded, and they will create jobs, grow, and sustain economies.
Okay, so the UN has, 17 Sustainable Development Goals?
Yes.
Okay. How important are they to you guys in relation to your impact investment methodology?
So we want to, and we apply a perspective of every investment that we do, how does it further one of the UN SDGs at the minimum?
Yeah.
Is it, for example, promoting decent work? Is it supporting economic growth? Is it being more financially inclusive of underserved segments like women, minority communities?
Yeah.
Is it furthering sustainable use of resources or decarbonization?
Yeah.
So all of our investments have to fulfill some of that. We have investments ranging from, we've supported a business that installs energy efficient hot water units for commercial businesses in Australia, all the way through to investing into women founders who are trying to grow a new business in a niche segment and they face a lot of uphill challenges. So it's a variety of social and environmental, I guess, lenses that we look through in our investments.
Cool. Just generally, Tanweer, man. All right. I think it's SDG 16, all right, of the UN Sustainable Development Goals. From what I remember, it's about strengthening institutions, okay? And it's the worst performing SDG, all right? Development goal by the UN. And bear in mind, from what I recall, unfortunately, most of the SDG goals, or SDG, all right, are not being met, okay? Which is very, very sad.
Yes.
But it's not surprising considering the level of conflict that we're seeing globally, not just in terms of military conflict. We're now talking about economic conflict, okay?
Yes.
So we're seeing a considerable change in the global economic order. I think now, more so than ever before.
Yes.
In the investment universe, because with us, we're in the listed stocks and share space. And for the sake of the audience, Tanweer is in the unlisted space. So what that means is he's supporting investments in smaller businesses, medium-sized companies in order to scale, correct? And what I think is increasingly important, especially in this particular space, is how you can actually manage volatility, all right? Yes, in the listed space, okay? But even your space, all right, I do appreciate the volatility means something different here, okay? It's more to do with solvency and survivability. So yeah, keen to hear your thoughts on that.
Absolutely. What we're seeing, particularly in the last sort of decade or two, is the proliferation and growth of alternative assets. And what alternative assets simply mean, it's an unfortunate term because they kind of lump everything into it, but the traditional assets are stock market listed stocks in companies like FTSE, S&P 500, ASX 200 in Australia, property, maybe some commodities like gold, and you got bonds. So in the listed markets, you got stocks, but you also got bonds, which is a debt instrument for corporations and governments to raise funding for 5 up to 30 or more years. Now, what we've learned, if we observe, is a small part of the global investor community who tend to be very sophisticated or have access to alternative deals, things like high value art or sneakers. They have access to those deals, but they also have access to private equity, private credit. Private equity being buying stakes or buying out companies from a merger and acquisition and then trying to grow it further or leverage it and so forth. And private credit being short-term debt to either property-backed or businesses. Now, what we understand is that those strategies that have grown and there's been demand for them because they want to avoid the volatility of traditional assets. They don't want to have a repeat of 2008. They don't want to have a repeat of property crashes like that happened in Dubai, for example, and other markets. So that is available and that's growing. And that provides a strategy for diversification. We're not putting all our eggs in the one basket. But also, when the market is in a bear market, people are still making money. Especially high net worth. And you look at the endowment funds like Harvard or Yale, if you look at their portfolio composition, their strategies have also changed. You can look at their portfolio was maybe 30 years ago. Alternatives make up a bigger percentage of their allocation. The question that I kind of wonder is, why isn't that available to the mass market? Why is it that the average Joe is facing the full brunt of a bear market and they're not accessing these alternative assets? So part of our work is to make private credit as an alternative asset available to a wider audience. And so that's what we are trying to do. And yes, it's addressing. Can you explain
private credit?
Private credit is essentially where two institutions are exchanging. So you've got a fund, a credit provider who are providing funding to a private business that's not publicly listed on a stock market. And they're outside the banking system because they're not sort of relying on a bank to provide their fund. It could be individual private investors coming together in a collective or through a fund that's still a licensed, regulated entity, but the investors are operating in a private capacity. So, and in our case, our private credit is short-term.
But Tanwa, you know the biggest question now is Trump's tariffs affecting you guys.
So,
and economies that you are focusing, your businesses are focusing.
So, look, I get this question a lot, and we've had some investors ask, but the beauty is that our assets are not correlated to the S&P 500 or the industries that rely on the S&P 500. So our deals are in countries and companies and industries that serve the broader economy. They have niche markets. For example, I mentioned we invested in a cybersecurity company in Australia that services a wide spectrum of the economy. And cybersecurity, people are going to need that regardless of whether Trump has a tariff or not, because everyone wants to protect themselves. So for us, we're primarily in markets that don't kind of track the Fed Reserve interest rate or how is the Dow Jones Industrial Index performing. And secondly, we're very diversified across many economies and many industries. And that is a key part of our strategy to manage volatility. So yes, there will definitely be some ramifications of what's happening with the tariffs. But is it going to have the same correlated effect in every industry, in every market at the same time? Highly implausible. Even if we look at the global financial crisis in 2008, I still have friends in certain businesses that I worked with like, what is that? I have no idea. You and I read the financial news and we're kind of glued to our screens. But one statistic I read from a book by Morgan Housel, and I strongly recommend that book, Psychology of Money, maybe you've come across it, says that in one of the statistics, and I'm going to misquote the exact number, but you can get the idea and maybe fact check it. The percentage of unemployment from the GFC was not as big as it kind of sounded. I think it was like only 10% of industries that were directly affected by the blowout in the stock market. So sometimes in our mind, we kind of think that the stock market, and particularly the US stock market and those major trading economies are somehow going to melt the whole earth, and it doesn't. There's a lot of people who continue their day completely unbeknownst what's happening. So I think that what we're not seeing as much of is that private markets are very vital to economies, and they are basically what we're trying to draw out and make accessible to everyone.
Thank you for watching. Join us for part 2.